Hi, this is Ferre with Tax Sale Support with another video in our Tax Sale Fundamentals series. The topic of this video is tax sale risks. We want to talk about what tax sale risks are out there and how you can both identify and avoid them. So, with that in mind, what is the biggest risk that tax sale investors face? Now, tax sales are it's a broad term to describe several different investment strategies, but if we're talking about tax sales in general, what are the biggest risks? Because there are still risks associated with the investment. Let's talk about what they are and how you can identify them. So, the biggest risk to tax sale investors, hands down, is useless land. Useless land is the term that we use to describe uh, lots of different types of land, but it generally all has some of the same properties. So, some of the things we're talking about is that the property has no apparent use. Okay, that's kind of an obvious one. What exactly can the property be used for? Something you should be looking at with every property that you consider investing in. But also, no real world value. And real world value is different from an assessed value that the county may give. A real world value means a value that the property will actually sell for. Okay, so we're talking about actual selling prices, and this is also why it's important to base all of your everything on comps. You're always looking for other comparable properties that you can compare your property with when you're trying to determine the maximum bid amount or what the selling price should be. Other types of property, this can include sometimes they're landlocked properties, meaning that there's no access to the property from public roads. The only way you can access the property is through other private property. Other characteristics, oftentimes these properties are small and irregular shaped. So when we say small, we're usually talking about less than a tenth of an acre. So they could be between a 15th of an acre or smaller, essentially too small to fit any kind of a building or a structure on. These can also be properties that have certain easements placed against them, which the easement is it is the local government reserving the right to use the property for a certain use, like for instance drainage or power lines and those types of things. So those are oftentimes things that the properties have in common. Now, why exactly is useless land such a risk? Well, the answer is a little bit different depending on whether we're talking about tax liens or whether we're talking about tax deeds. For tax liens, the reason why useless land represents such a risk is because of the way the investment works. Tax liens that don't redeem within the redemption period must be foreclosed on in order for the investor to get their investment back. Or at least you need to pursue foreclosure on it until the party that owns it is willing to pay the taxes to avoid losing it. So the question you have to ask yourself is when you're looking at some of these properties, if a property has no real world value, in other words, if you can't actually turn around and sell it for anything, what is the point of foreclosing on that property? Why own a property that you can't sell or that has no real use? And that's ultimately the problem. The problem with useless land with tax liens is that you could end up owning it. That is something you have to consider with every tax lien that you buy. You may be purchasing a lien against the property, and it may have a very high chance of redeeming so that you earn a high interest rate return. But you have to keep in mind that if that doesn't occur, that the lien has to be used to foreclose on the property, and that should be the ruler that you use to measure every tax lien you consider buying. If we're talking about tax deeds, it's a little bit more simple. When you're buying tax deeds, it's a simple buy and sell strategy. It's a buy low, sell high. So, would you want to purchase something that you didn't have the ability to sell? And that's really the gist of it. You don't want to buy property that you can't turn around and make a return on through selling it. So, uh, every property that you invest in should have use and it should have verifiable value. So when we say verifiable value, what do we mean by that? A sales history could count as verifiable value. If you can see that the property sold 10 years ago for X amount, that's a clear indication that the property has real value. Um, Other things you could look for are other comparable properties. So if it's some kind of a building lot, well, what are similar building lots selling for? If other building lots have a home on them, then how exactly is that building lot valued compared to the home? There are a lot of questions like that that you can ask about useless land, but that's why it is a risk, is because you don't have the ability to turn around and sell it. It's not sellable, is another way that you could also describe that. Now, useless land isn't the only risk. Uh, there are also toxic tax liens and tax deeds. What do we mean when we say toxic tax liens and tax deeds? Because some of these terms are terms that Steve and I use or that we came up with, not necessarily industry wide terms. So you may not recognize the term with different counties. But what exactly are toxic tax liens and tax deeds? Well, you'll come across these sometimes if you're looking at lists. What do they normally have in common? It's normally multiple years worth of delinquent taxes that were never paid. So the more years you have of delinquent taxes that aren't paid, the higher the opening bid amount becomes on the property, or the higher the lien amount is. And ultimately, what happens is your bid to value ratio begins to increase. You begin to have problems with it. So, uh, for instance, you could have a lot of these properties are properties that have been offered multiple times, or liens that have been offered multiple times, over the years. For many counties, if they don't sell a tax lien or a tax deed initially with their first sale, sometimes they'll hold subsequent sales. It's more common with tax deeds to have subsequent sales because most counties that have leftover liens will simply offer them over the counter. But some tax deed states don't offer over the counter, so what they do is hold subsequent sales. So these are properties that may have been offered several times, but the problem is every year that they're offered, they become less and less appealing because the cost continues to go up. So the value of the property doesn't go up, but the cost to buy that lien or that deed does go up, which makes it undesirable. So uh, different examples might be if you're looking at a property, if you're looking at tax liens and you see a lien that is 20%, has a bid to value ratio of 20%, meaning let's say that the lien is for $1,000, the property is estimated to be worth $5,000. Okay, that would be odd for liens because liens generally have a very low bid to value ratio. We're talking about usually less than a couple percent in most cases if it's a regular lien. If we're talking about deeds, then that number can jump up to where you have a deed whose opening bid to value ratio becomes too high. Now that can vary and change depending on what too high is. It depends on the property. For instance, some properties that have a higher degree of profitability in them, they offer more in terms of the percentages that you can work with there than something like, let's say, a piece of raw land that has less overall profitability. But with tax deeds, if we see a tax deed that has a bid to value ratio that's over 30 or 40%, then you start to get a sense that maybe there's something wrong with the property. Ultimately, you'll have to determine for yourself exactly what the percentages are for you because it tends to vary from investment to investment. But you definitely get a sense when you're looking at some of these that there is too much owed on those properties. And so, oftentimes, one of the things you can do to check that or to see what's going on with it is to check the history of property tax payments. And if you check the history of property tax payments, you often come up with past years that are still delinquent and owed. So in this case, I cut out a couple of examples here, or I guess a couple pieces. This first part on the top is just a portion of the list that I copied that showed that this is for a lien that is for $2,700. But when you go to look at the history on the property and some of the information related to the payment of property taxes, we can see here that it hadn't had property taxes paid in 2010, 11, 12, 13, 14, 15, And so what you end up here is, even though the lien amount shows $2,300 here, the actual amount that would be required in order to foreclose on this property, because all the taxes have to be current, is an astounding amount. I mean, it's closer to $20,000 instead of the $2,700. So, all these things are important to remember when you are looking at investing into tax liens or tax deeds. If you like these videos and you'd like to watch more, please subscribe, or you can also go to our websites, secretsoftaxlieninvesting.com, to get your own free ebook, or you can go to taxsalesupport.com, which is our member site. Thank you so much for listening.